Hi, Malta. I hope that's you, Carl the presenter. Hope you can hear me okay. Great. Okay. Well, I think I can just. Oh, the record button's already been hit. So I will. If you'll bear with me, I'm just going to get ready to start. Good evening, everybody. It's Paul here, and it's Tuesday, the 14th of June, 2016. 14th of June already. And tonight we're here to talk about pin bars, which is another one of the value trade price action webinar series that we'll be looking to deliver over the coming months. And before I dig into what a pin bar is, as always, we just start with a very quick risk disclaimer. CFDs and FX are leverage products and carry a high level of risk to your capital. It is possible to lose more than your initial deposit, and you may be required to make further payments. These products may not be suitable for all clients, so please ensure you've fully understood the risks involved. So, as I said, this is another one of the price action webinar series that we're looking to deliver for our clients, value trades clients. And what we're going to talk about today is pin bars. So, what I'm looking to cover through this particular session is a basic introduction to pin bars. I know some of you may be aware of it, some of you may never even heard of it, some of you may know them by a different name. But I'll talk about what are they, and then I'm also going to give you a little bit of an insight into, how I view pin bars in terms of what they show. It's a little bit different, but I would ask you to bear with me because what you're actually also getting is how a professional trader views markets and also views how the pin bar's relationship with the market. We'll talk a little bit about how we use pin bars. There's a couple of different ways, and also, how to trade pin bars. How actually use them as part of an overall trading method. So, what is the pin bar? Well, it's probably the most frequent pattern that you'll see in markets. It's very popular. You can Google pin bars on Google, and you'll find all sorts of information that will come back to you. Okay, but invariably, there's with all that, there's still actually some smarter ways to trade it. And one of the great things it does is it gives us a great indication of supply and demand within the markets, and they're very clear and easy to see on charts. Now, and the truth of the matter is, the majority of traders are actual visual traders, so something that is a very clear and easy to see signal on a chart helps enormously. As I said, they're very popular, and many people will trade them, but not all like myself. And so I'm going to share with you a couple of ideas about how I look at them, how we view them, and what we're actually sort of viewing them as. So if you've no real idea what a pin bar is still, it's this here, this candle here, okay, this particular one here. Hopefully you'll just excuse my artist's talents, but this is what's known as a pin bar. So why is it known as a pin bar? Well, let's go on to the next slide and have a look at how it's come about and what it's created. So, well, why is it called the pin bar? Well, it's after the character Pinocchio. So the Disney, I'm sure you all as children saw or either saw the Disney movie or read the book about Pinocchio. And namely, when Pinocchio, if you remember, when he told lies, his nose got bigger. Right? You'll undoubtedly remember that. Well, here we go. In the financial market, the pin bar is lying about the direction of the market. Right? That's the key thing to take away. It's lying about the likely next direction of the market. And I'm going to show you that, and we'll talk about how that shows up, and more importantly, how we can use that, right, to our own benefit. So here's where we start. As I said, I want to give you a little bit of an insight into how a professional trader views markets, how a professional trader views pin bars. Now, this might be a little bit different from what some of the textbooks you've read, but the whole idea is to give you, a little bit of different insight, okay, a little bit of something that might challenge the way you've thought of markets or the way you've looked at markets. As I said, this is the way I look at them, okay, and this is the way I view them. So I consider price, okay, when we see price moving across a chart, I see price as like the herd, almost like the herd of wildebeest you'll see crossing the sort of, the savanna plains of Africa. And what I'm looking at is, when I look at a chart, I see prices moving from one obstacle to another. And normally those obstacles are levels of support and resistance, which we've covered in some of the other webinars that we deliver for clients here at Value Trades. And that's the way I look at it, in the same way that a herd moves from obstacle to obstacle across the plain. So like, the herd moves across things like river crossings or choke points, etc. The same is true for financial markets. Price action, it moves from obstacle to obstacle. It can be those levels of support and resistance, maybe even a zone of supply and demand. But that's the way price moves. And that's the way I look at it. And that's the way you'll see lots of professional traders will look at the way price moves on the market. So you may not have thought of it in that way. You may be completely and utterly, new to you to think about that. But bear with me, ladies and gentlemen. There is more to this, which I'll share with you. But I want to give you an insight into a professional trader's mindset. So as I said, we're looking at, that price is moving from obstacle to obstacle, and for most of us, a lot of those obstacles will be, horizontal levels of support resistance, or maybe it's even sort of dynamic ones that are trend lines or moving averages, that act as those obstacles, and that's what price does. Price, it doesn't move in a straight line. It basically moves from obstacle to obstacle. Right, and that's what we're looking at, and it's about understanding and almost like foreseeing where those obstacles are that start to create and provide us with opportunity. How does it create opportunity for us? Well, here you go. It's near that those such obstacles that actually the major predators are lying in wait. So when you look at, when you watch David Attenborough doing his, programs for the BBC, and you watch that herd crossing the savanna plains of Africa, invariably it always cuts to a piece where the major predators are lying in wait, and hopefully maybe you can see on that picture, if it's clear enough, there's 3 lions in there hiding away. You can see how effective their camouflage is. But that's what we see in nature. That's what we see on the savanna. Okay, that's what we see on those African plains. And invariably, that's what we also see in markets. Right? That's what we see in markets. So the thing is, at those obstacles, as I said, that's when those predators are ready to attack the herd in order to defend territory or for profit. Now, for an after, profit for him is getting a nice juicy wildebeest, okay, or and that's his particular profit. But what happens is, we see this time and time again in nature, and you start to also see this time and time again in the financial markets. What you start to see is, on the savannas, you start to see the herd starts to lurch from one ambush to another as the predators attack. And in financial markets, right, price action lurches from one ambush to another where the major trading predators are looking to attack. And what actually happens is, for the herd on those African plains, you see the short-term direction of the herd will change to avoid the predators, right? They will change to avoid the predators. And that's the same in markets. That's the same in markets. Markets will change direction to avoid where the predators are. And this is where the pin bar starts to come into its own. Because, ladies and gentlemen, in the markets, I see tails, okay, the wicks, as the most likely indication of where the biggest predators are lurking. Why is that? Because when you see those tails, they show rejection of a particular area or a particular direction. As a private trader, it's pointless to try and fight them. Don't try and fight them. When you see, like you see here, okay, when you see lots of pin bars, when you see lots of tails like that in a particular area, well then actually the best thing you can do is don't try and fight them. Don't try and fight them. It's pointless. What you want to do is to work with them. Think of that when you see those big tails, that's where a big predator has come into the market and taken a bite. It's where they've attacked the herd. The herd has been wandering down here. The predator comes in, takes a big bite, and the price goes in a different direction. And what happens is we see that it happens here, and it also happens here. This starts to give us fantastic insight into what the market's doing. It's starting to almost leave tracks of where the biggest predators are lying in wait. And as I said, in the market, as a private trader, it's pointless to try and fight them. Don't try and fight those big predators, but actually use the information. Use the almost like those tracks, those animal tracks, to give you an indication of where those predators are lying in wait, and to actually to be able to use that for your own advantage, to almost switch from being one of the wildebeest herd to switching across to being one of the major predators. So with that in mind, we need to really understand, well, what actually is a pin bar? How does it work? How can we utilize it? How can we put it together? What are we actually looking for? Well, there's a few simple rules that we like to use with pin bar that keeps us from sort of chasing down poor signals. So a pin bar must have the open and close within the body of the previous bar. So here we go. That's our pin bar. It's open, right, and this is where it closed. All right, open and close within, all right, within the previous bar. Furthermore, what we like to see, what you'll see is kind of the candle wick. We like that to be 2 to 3 times the length of the body. Hopefully you can see how that there is there's a long body there, sorry, a long wick there, and a small body here, and that's what we're looking for. And ideally we want to see that long nose, that Pinocchio nose, protruding out from all other bars. That's what we're looking to do. And if you look at a chart, if you after tonight's session, you go away and you look at a few charts yourself, what you'll find is the better pin bars, they stick out and they are very, very obvious. That's the whole idea about it. It's a really good visual pattern that gives you an insight into what's going on in the market that anybody can start to learn and utilize to help improve their trading success. So here's a part chart of some bullish pin bar examples. Why is it bullish? Well, because we expect price to be bullish. We expect price to go north once we see this. So here's a great example. Okay, and what we're seeing is nice small body with a really long wick. Okay, we can see that here on these other two examples. Think about this though. This one is maybe some people might look at that and say, well, I'm not sure about that because the wick isn't 2 to 3 times the size of the body, and they would be right. And this is just the kind of, let's say, the one exception to the rule where we're thinking that. Think about this. We're expecting price to change direction, so price has probably come down, and then it's opened here. Price has gone down, and then price has gone all the way back up and closed on its absolute highs. That is a very, very bullish bar. That is a really very big bullish bar, and so we can expect price to sort of head off north afterwards. So that one we actually look to use. The one next to it, this one, this is actually a no-no. This is a no-no. Think about this. Think about it. It's a red bar. So price will have come down. It will have effectively have opened here. Price has gone down during the day, and it's actually come back up about half the way and closed on it, about halfway down the bar. If you're looking and thinking about that, the bears are still really in control of that bar. The bears are still in control of that bar. There's still a big strong body on that, so that doesn't count. And on the flip side, well, what we're looking at is bearish, all right? Bearish pin bar examples, right? So what are we expecting? Well, we're expecting price to have been coming up, all right? It's been rallying up, and then we'll see a bearish pin bar, okay? The wick is to the north, all right? And then what we're expecting is the price to head south. So you can imagine these first three, they're great examples, all right? They're great examples of it. Okay. Here's the next one. This one we allow. This is the sort of the one exception, because think about it. Prices effectively has come up. It's opened here. Price has gone up there during the day, and then price has fallen all the way back down and closed on its lows there. It's a real reversal candle. It's a real reversal candle, and we would expect price to drop down from it for the next day. Whereas this one, if we same as the previous slide, really, we're expecting price to have gone up. Well, we can see now, we know that the price opened there, price pushed up and closed down, but it closed down. It still closed higher than it opened. All right, the bulls are still in control. All right, so it's not a terribly good bearish example. That's why it doesn't really count. But these first three in particular are lovely bearish pin bar examples. Nice small bodies, nice wick, okay, 2 to 3 times the size of the body, and that's what you'll start to see on charts all across the way. So I said I'd start to give you a little bit of insight into the different ways that you can actually use pin bars. Now, very often what you'll find is once people start to identify these signals, they trade every pin bar that they can across all of the charts, across all the time frames. And whilst there's an element of great discipline to be able to just trade every single one of them, what you're probably going to find is if you do that, your hit rate's probably only going to be about 50%, maybe even a little bit less. So what you need to do is to be just a little bit savvier, a little bit smarter, or just a little bit cuter in the way you utilize pin bars when you see them. So what very often you'll see is that pin bars can be used to signal the end of a trend. So this is a chart from a couple of years ago. It's one I was trading very actively myself. It's the pound against the Swiss franc. It's the weekly chart, and realistically, for about a year or so, this was only going in one direction. It's going all the way down. And remember, this is a weekly chart, so it was moving down strongly up until the Swiss National Bank imposed their peg on the Swiss franc against the euro, the 120 peg, which fell apart sort of a year last January. But actually what we had here is this was the pin bar, all right? And remember what we're talking about, pin bar is lying about the direction. The pin bar might be pointing down, but actually what happened is price went all the way up, all right? That big pin bar is what ended that trend. It ended that downtrend, okay? Now I'm not saying you can't use pin bars for that. A lot of people do. It is viable, but its success rate is not as high as when we actually utilize them to trade with the trend as part of a small pullback. So this is the same chart. This is the same pound against Swissy chart. But actually, what we had here is price. You saw from the previous chart, price was just moving its way down. And actually what happened is price pulled up to a level of resistance. Okay, we always like to have a confluence of events. This was just a 20 period moving average, all right, and it then put in a nice bearish pin bar that was also a lower, also a lower high, all right. So starting to get lots of 2 or 3 things all coming together, and then invariably what happened is we were able to short that, and it ran very nicely for the next 3 to 4 months. So that's how we like to use pin bars. We prefer to trade them with the trend as part of a particular pullback. All right. So if we want to identify a trend, and when price pulls back, when we see the pullback end with a nice pin bar, well then that is a great opportunity for us to take a calculated risk trade. Okay. There's always risk in every trade, but it is relatively low risk trade, and that's what we're always looking for. So what I wanted to show you here was here was a chart. This is the weekly chart of the S&P 500, and what I just wanted you to have a look at is that this is the weekly chart. One of the things about pin bars is that they are what I would call time frame and instrument agnostic. Doesn't really matter whether you're trading FX pairs, whether you're trading indices, whether you're trading commodities, whether you're trading fixed income, right, or whether you're just trading individual stocks. Pin bars appear across every single asset class. Not only do they appear across every single asset class, they also appear across every single time frame. So it is a very, very popular signal that can be seen and utilized and built into your, let's call it your trading armor. So what we have here, as I said, this is the weekly chart on the S&P over the last, well, it's effectively over the last 4 years. So this is just one chart, all right, one chart, one time frame, and you can see that, well, for most of us know that the S&P was in a very lovely long uptrend for since about 2009. And effectively, what happened is, every time it pulled back, very often it finished. All right, it finished with a pin bar. It finished with a bullish pin bar that gave you an opportunity to effectively to buy into the market. And even when we had a bit of a collapse last summer because of the issues about China, invariably what we had was the collapse ended on bullish pin bars. And even earlier this year, you can see the S&P 500, it effectively, when it pulled back, its pullback was ended by some bullish pin bars. And what you'll find is that there's been quite a few fund managers who've done very, very well over the last 4 or 5 years, simply just quite literally the pullback in the trend. Just very, very simply buying the pullback in the trend. When you see that pullback, and when you see that pullback end with a nice bullish pin bar for an uptrend, well, that's a very, very simple, very logical, very rational place to step into the market and actually engage with the market. You're buying at a lower price. You're giving pin bar is giving you an indication that the big predators are there. They're going to wait to bite. Okay, they're going to wait to buy. And as I said, you don't want to fight them. You actually want to use them. You want to have them on your side, all right? You want to switch sides from being one of the wildebeest to actually being one of the lions or crocodiles that are going to take a big bite out of a price movement. So that's what I want you to think about. And what I'd be saying to you is just take some time, go and have a look at any chart. Just pull up any chart. It doesn't even really matter what it is. It doesn't matter about the time frame. It doesn't matter when it is. Whether it's it's a right up to date chart or it's one from 10 years or so. And just go through and look for all the pin bars on there, and I guarantee that you will find plenty. I guarantee that you'll find plenty of very successful pin bars that were the end of pullbacks in a nice particular trend, whether it was bullish or bearish trend. So, as I said, what we're looking at, the safest way to trade pin bars is where possible, trade them within an identified trend on a pullback off a support and resistance level. And that support and resistance level can be a horizontal level of support and resistance. It could be a dynamic one, okay, in terms of a moving average. It might be, a Fibonacci level, which we covered last week, if you remember rightly. It might be a pivot level, which we also talked about, okay. If you're trading on an intraday basis, price is in a downtrend, it pulls back to a pivot and it puts in a pin bar there. Well, that can give you a very, very solid little trade signal, very simple one to be able to follow and trade. So how do we look to enter this? How do we actually look to enter? Well, there actually are several ways to enter, and a lot of that is based on your risk profile. It's something that we've alluded to in the past, that here at Value Trades, we can teach you pretty much everything really in terms of technical trading. All right, we can teach you all about the technicals of trading, the fundamentals, the trading psychology, the risk management, the sentiment, the geopolitical. We can cover everything. The one thing that a person has to understand themselves is their own particular risk profile. Some people are very risk accepting. Other people are very risk averse. Only you only you know what your own risk profile is. It's not something that anyone can really teach you, you know. And what I find is, you know, I speak to rooms of hundreds of people, is that you know, everybody might have the same way of trading, but everyone will have a very different risk profile. It's about understanding what your own risk profile is. So tonight, you know, as a basic introduction, what we're talking about is I'm just going to give you the you know, the kind of standard safest way. So, you know, here we have, you know, the price has been in an uptrend. It's pulled back a bit to the 20 period moving average. And what do we have here? We have a very nice bullish pin bar. Just that was there. Okay, nice big wick. It's pointing out from all the other, stands out from all the other candles as well. So what you look to be doing is your entry, you know, your entry would be above the high of the pin bar, and your stop loss would be beneath the low of the pin bar. And that's a very standard way. So, you know, you're hoping that as price pushes north, okay, it triggers your entry order, and your stop loss is beneath. So you know, I've talked about all the time is, you know, it's important to know your entries, but it's also important to know your exits. So, you know, if price comes down and touches your stop loss, well, then invariably, you know, the trade is not worked out, and you move on to the next trade, but you've done the smart bit of managing risk. So invariably, what you'll have is that, you know, you'll have, you know, bullish pin bars like that in an uptrend, and you know, the very simplest way is to just buy when price breaks above the high, and you'll actually, you know, put your stop loss beneath the low. And that can be the opposite way for you know, bearish trending. For a bearish, you'd have a sell order beneath the low of that pin bar with your stop loss above the high of it. Very safe, very standard, and you know, an absolutely fine way of doing business in the markets. What you might find is that, you know, if you trade in the bigger time frames, so, you know, daily, weekly, even monthly, is that, you know, you might find that you know, just the mere size of the candle, you know, might cause challenges with you know, a sort of trade management. So you just need to be aware of how to actually to manage that, and that's something that you know, your valued trades representatives will be happy to discuss with you in terms of, you know, how to sort of advance ways to be able to manage a trade like that on a much bigger time frame. But, you know, for most of you, you know, when you're actually, you know, you're identifying a trend, finding a pullback, seeing a you know, a pin bar trade set up at the end of it, that's the kind of trade that you can just take, you know, day in, day out, all right? And it's a sort of trade you can get very disciplined and very good at, and very easy to work with, and that's what we're looking for to do, is have something that is very simple, that stands out, that you can actually trade again and again with great ease, and very simple. So you know, to kind of finish up from what we've talked about here, is that, remember, you know, we talked about pin bars, that they are likely indicators of where the biggest predators are lurking. Think about that, all right? I know it might be a little bit esoteric, a little bit different in terms of the way I look at the market and the way I describe it, but there is method in my madness, ladies and gentlemen. All right, pin bars are likely indicators of where the biggest predators are lurking. So in the markets, that could be the biggest pension fund, that could be a central bank, that could be a hedge fund. Okay, you know, it could be a multitude of things. You know, the reality is you're probably not going to know who is there, you know, the exact identity of who's there. But, you know, when you start to see pin bars being printed there, you know that there is a big predator. And as I said, okay, that's what it's doing, is it's showing rejection of a particular area or a particular direction. So as a private trader, it's pointless to try and fight them, all right? Don't fight pin bars, okay? Don't fight them, all right? Start to utilize them, work with them to show the likely short-term direction, which is going to be the opposite way of the way that the price came into that pin bar. You know, it's, remember that Pinocchio's nose, all right, when you've got a nice big Pinocchio nose, all right, pointing in one direction, the likelihood is price is going to go in the other direction, all right? You know, the pin bar is lying to you about the direction of the trend. It's going to go the opposite way from the way the pin is pointing. So utilize that information for your own benefit. And as I said, whilst pin bars can be utilized for both to signal the end of a trend, what we like to do is to actually ideally look to utilize them to trade with the trend. look to utilize them as part of a pullback in an existing trend that finishes with a nice pin bar that gives you a very solid standout entry signal to be able to enter that market and join the fray, so to speak. And invariably for a bullish pin bar, you're looking to have your order to enter just above the high of the pin bar, and your stop loss would be just beneath the low. And for a bearish pin bar, if you're looking to sell, would you be selling beneath the break beneath the low of the pin bar with your stop loss above the high? And there you have, at the start of a very simple but very robust trading plan that you can utilize day in, day out, on whatever time frame you trade and whatever asset class that you particularly trade. So I hope you found that useful, ladies and gentlemen. I hope you found that a little bit insightful. I appreciate some of you may, have seen pin bars. Some of you, as I said, may have known them by different names. You'll hear them called rejection candles or high test candles, low test candles. But the whatever the name you might be given is, it might be different, but the characteristic of the candlestick is exactly the same. As I said, it's a very, very popular candlestick. So go away, bring up your value trade trader 4. Just open any chart. Okay, it doesn't matter really what it is or what time frame it is, and just go through and start to identify the pin bars. Have a look at the ones which ended trends, and have a look at the ones which were great little entries on pullbacks in an existing trend, and see if you could start to wrap up and create a tactical trade plan that you can use just around that. So as always, I hope you found that useful. I hope you enjoyed that. I wish you the very best of success in your own trading. If you have any particular questions, please don't hesitate to get in touch with your value trades representative, and I'll be very happy to help and guide you. And as I said, I wish you the very best of success in your own trading endeavors. I look forward to speaking to you soon. Trade well.